Joining us, Ali Mogharabi is an equity analyst at Morningstar covering the stock. Tom White's going to do some trading with us here in a moment. So, Ali, walk me through it. Is this just like an unwind from the Uber sympathy pop or what?
To a certain extent, yeah, I think it is. And also, I think expectations were not as high as the market had expected. I'm sorry, the guidance was not as high as the market had expected. So in addition, of course, you had Uber last week basically talk about those guys becoming profitable in terms of adjusted EBITDA at the end of Q1 next year. So, the market basically expected that Lyft would actually, basically talk about their guidance and actually move their profitability a little bit ahead of that Q4 in 2021. So you combine those and yeah, I mean, there is, that pretty much explains why the stock is declining.
So help me keep track here. I know you just mentioned it, but I want to come back to make sure our viewers get the profitability expectations for each. Because remember last year it was when Lyft's CEO was at that Wall Street Journal conference, he talked profitability and stock popped and it got a little edge over Uber. But now Uber moves up their timeline. So who's in front now for profitability?
I think both are doing pretty well. I think to a certain extent, many are not necessarily realizing that Uber has a 70% market share. So it's
wow.
Scaled that in the United States, yeah. So it's scaled that business a lot more effectively and a lot more quickly. We're talking about only ride sharing, of course, than Lyft has. So I think the expectations were a little bit too high. A little bit too much optimism regarding Lyft. But I should say that we still think that both stocks are actually pretty attractive. With Lyft, we've got a $72 valuation, and with Uber, we still have a $58 valuation.
So what do they need to do to pick up the market share? Because if this is going to be a cutthroat, kind of race to profitability, I imagine, look, Uber's probably looking at that other 30%, saying the more we can get, the easier it is for our scale. Scale, I imagine, still is important. So how does Lyft keep what they've gotten, if not expand it?
Actually, to a certain extent, I'm going to have to disagree on that.
Okay.
I think that 70-30 split when it comes to the U.S. market share, I think both companies are pretty comfortable with that. I don't think right now, especially, that Uber is actually investing a little bit more in Uber Eats, and it's facing pretty much intense competition on that front. I don't think any of those companies necessarily want to undercut each other when it comes to pricing. And that's why during the last 9 to 12 months, you've actually seen some so-called pricing rationalization and or pricing stabilization. In my opinion, it doesn't necessarily benefit either company to continue to aggressively price when it comes to the ride-sharing part of the business.
As governments, they'll continue to push back, Ali. I mean, in California, here in Chicago, they're hiking up the taxes 30% in the main downtown area. How long can the two be friends, if the going gets tougher here? We saw Juno try to make a stab at it in New York. 3 was apparently too many. Will 2 be, the sweet spot?
That's the way we're looking at it. And that's why you've actually seen that rationalization or stabilization in pricing that I just talked about. I think, as you mentioned, I think 2 is pretty much the sweet spot.
Okay, so right now, then, for the investment standpoint, 2 in terms of revenue flow, fine if the pie is big enough. But for investors, is there going to be a better option? Or I know that right now you like both. Will there be at some point a deciding factor if Uber's other ancillary businesses make it a speedier path towards the bottom line growth?
I think for Uber in ride sharing, that's true. We agree with you on that end. But in terms of the entire company and profitability, and I'm talking about GAAP profitability, we don't necessarily see that until 2024. And when it comes to GAAP profitability regarding Lyft, we don't see that until 2023. So if you have a lot of patience, we do think that Uber in the long run is a better investment because Uber is in the process of diversifying its business. We talked about Uber Eats a little bit. Of course, they've got Uber Freight and so forth, and they have actually expanded internationally where they have market share, where they're either leading market share or they basically have second place. So from a long-term investment standpoint, we like Uber more than Lyft. However, in the short term, let's say 2 to 3 years down the road, we still think that you could see a pop in the stock a little bit sooner than you could see it in Uber, because in our opinion, it's a little bit easier for Lyft to move towards profitability, especially when it's focusing in only 1 or 2 markets. Right now, the United States and Canada.
Ali, one thing that I've discussed here is the importance of the macro backdrop. I still largely consider, especially with the increased taxes, these services to be, for the most part, somewhat premium services for most people. Do you agree with that? Do you need a strong backdrop? Do we need to have employment stay where it is? Do we need to have the U.S. economy to stay robust for Uber to have that timeline? I mean, I imagine the better the economy is, the longer this kind of timeline and runway they might have. What do you think?
Actually, we don't necessarily think that the macro backdrop necessarily has that much of an impact. On the pricing front, yes, they are facing some regulatory pressure, which could actually increase the prices. As you know, they pass down the additional cost most of the time to the consumer. However, we think that the business is scalable enough, and to a certain extent, the demand is high enough where they can actually have some flexibility in terms of the pricing. Because what happens is, if they face additional cost, they can actually split that additional cost to either lower the take rate for the drivers, which, by the way, that's the supply side of the network effect. A lot of the drivers will continue to work with Uber and Lyft because the demand is still there. So they will split that cost, that additional cost, with the drivers and also to the consumers. So a negative so-called macro backdrop doesn't necessarily mean that the prices are actually going to increase too far or too much for the consumers.
Yeah, okay. Ali, really interesting stuff. Hey, do you have an estimate for what the reclassification of the gig economy workers in California might do to the cost? I've seen the estimates like as high as 30-40%.
Yeah, that's true. But the way we're looking at that is that they're putting that measure on the ballot for November 2020, right? So we actually think that they're actually going to get a lot of support when it comes to election time. Okay. Also, remember that if that measure, or if that law, that AB 5 actually still remains in California, it could have a negative impact on the economy in California. So you could actually see a lot of the lawmakers, or I should say some of the lawmakers, support that AB 5 a little bit less as we move towards the election. All right. As you know, AB 5 could actually turn away a lot of the startups from setting up shop in California. They could actually move to Texas or other states such as Utah. So Californian lawmakers don't necessarily want to risk that.
Okay. Assuming California wants to do what's good for California. Okay, Ali, we got to run. Really nice stuff here.